Welcome again to our fifth episode of the Grey Rhino Show. Just now, I was talking to my colleagues just before the show started. We were saying, are we going against the preparation for election by holding our Grey Rhino Show tonight? Because today, by right at 8 p.m., there's supposed to be a political debate from four parties. But we are also having our Grey Rhino Show. Therefore, for those of you who are here today, I would like to thank all of you for wanting to be with us. But not to worry, if you would like to follow the debate, right, there is a Mandarin session at 9. Okay, so welcome again. And then for those who have been with us, thanks again. And then for those who are new, just some admin matters and some house rules. So when you look at your screen, you should be able to see either, okay, depending on the device that you are using, either on the top right corner or bottom right corner, you should be able to see a three dot. So when you click on it, you should be able to see a chat. So this chat function is for you to communicate with us and also for you to post your question. Okay, and just a reminder, when you post your question, remember to choose two panelists and attendees. Okay, Wissing has just said hi to everyone. So for those of you who be it you have been with us for the past few episodes or when you are here, we will be very happy to see your greetings and just hello in the chat group. Okay, so that is one thing. Okay, today we also need two device review. When I mentioned there are two devices, that also means we will be having a game at the end of the show. Okay, our Kahoot, our very, very exciting Kahoot game. For last episode's winner, Man. Man, I'm not sure whether you are here with us today, but I do hope that you have enjoyed the special present that we have gotten for you. Okay? Okay, so without further ado, let me just go through with you what's going to happen. Okay. In the past episode, you have probably heard Kate Wee sharing that there could be a possibility of round 2 due to the reopening of economy in various countries. So for the past 2 weeks since the last episode, how has it been? Later, Kate Wee will be sharing with you in the economic and market update. Then, of course, the next segment, we will be doing our case study. Our case study today is on this company called SPH. So I'm sure it's not a foreign name to all of you. I hope so. So this company, early this month, is announced that it will be replaced by Maple Tree Industrial Trust in STI. So what actually happened? Is it something wrong with the business model or what is the gap? So later during the case study, Kate will be sharing more with you based on the analysis of the company. Then of course, there will be a Q&A session. We have actually chosen 3 questions from the previous episode. And also for friends who have indicated their question in the registration link, we have chosen 3 questions which we feel that it will be useful to all of you here when we address to them. So we'll need to seek your help to choose which is the question that you would like to be addressed to first. Okay, so can we have the polling up for the 3 questions? Okay, I'm not going to disturb you by reading out. You can just read the 3 questions and then choose the one that you would like to be addressed to the most. Okay, probably we just take about 30 seconds. I hope that will be enough. Okay, then we shall stop the polling. Can we just take a look? Okay, seems like majority would like the question to be would like the first question to be addressed to. So we will do that later, followed by the ETF, the question on ETF, and then last but not least will be the outlook of gold. Okay, so thanks for sharing your views with us. Without further ado, shall we invite Kate Wee to come on board? Hello, Kate Wee.
Hello, Shireen.
Yeah. Thanks,
Shireen. And welcome everybody. Good to be with you all again, although I can't see you all. Okay, so this is episode 5. That means we are already 2 months plus, 2.5 months into this Grey Rhino Show. and we have a lot more exciting topics to be sharing with everybody. We've got it planned. Let's go to today. So today we'll be touching on two things. Firstly, is to continue to follow the story of this COVID-19, which has been a very extraordinary one. There are quite a few very renowned investors, renowned and successful investors, whom actually got it, who got wrong-footed totally by this crisis. One of them, of course, the very famous Mr. Warren Buffett. Second, Stan Druckenmiller, the right-hand man of George Soros. Yeah, and then Howard Marks from Oaktree. I think even Jeffrey Gundlach, supposedly the Bond King. Yeah, so I think, well, are they really wrong-footed, or what they have seen has not come? Okay, to now, nobody knows. I think they themselves also do not know. But I think it's great to follow this crisis so we can learn along the way. Even though our prediction may not come totally true, but at least we get to learn from this episode. And I think that's important. And secondly, today's case study, as Shereen said, will be on SPH. So without further ado, let me get started. Okay. Yep. So again, like I've done over the last few episodes, let's start with where the market has been in this year. Okay, so it was stable and then it dropped off the cliff and it quickly climbed back the cliff. So it, from the peak to bottom, it dropped about 33%. And then from the bottom to currents, it's also up 33%. But as you know, when you go down 33% and it come up to 33%, we don't get to the same point. So we are still below where we were at the start of this year. But let's look at what happened in the last 2 weeks. Our last Grey Rhino show was on the 17th of June. Right, so last 2 weeks, what happened? So we had a small uptick for 2% and then a 4% down. Okay, and what we're looking at is the MSCI All World Index, which we use as proxy of the global stock markets. So generally, it's down. So the last 3 weeks, 2 weeks were down. So what actually happened? Okay, so I think this is something we've been watching. Which on the 20th of May, that Grey Rhino show, I was saying, well, there's a very real chance of the resurgence of COVID-19, especially in USA, because of the way it's handled. President Donald Trump is very, very eager to reopen the economy because of his re-election in November. However, he doesn't give any strict rules or any guideline to follow. He left it to the decision of the governor. Of course, he wants it to open quickly, and without much, I'll say, guidance. So different states does it differently. Some are more conservative, some are more eager to restart the economy, or rather reopen the economy. And those that reopen earlier actually face the wrath of this resurgence. Let's take a look. Okay, so that's called this by Bloomberg. I call Mind the Gap. If you look at that, that's a 7-day rolling average new cases in USA and in Europe, EU. So in EU, since the peak in early April, it has kind of stayed at the trough, right? Whereas the blue line, which represents USA, it came down and then now it came up again. So now it's at an all-time high. So we call it, for Europe, why did it happen like that? Because it waited for the curve to be broken. That means it has really come down, subsided far enough for them to reopen the economy. Even that case, it is not completely without any risk of a resurgence. So Europe waited for the curve to be broken. US waited for the curve to bend. So the moment the curve bends downward, they started to talk about reopening of the economy. And hence, it opened in a big way. When Donald Trump wanted to have a rally session indoor of 20,000 people, and these people had to sign off to say that if they contract coronavirus during that rally, they cannot sue Donald Trump. So because of all these things, as I kind of said, the risk of resurgence is very high. Round 2, I call it the round 2 of a boxing match. Where the first round, the seemingly weak opponent doesn't get knocked out. So he came back for round 2. And this weak opponent we're talking about is COVID-19, which didn't prove so weak after all. So I think Singapore had also got its round through, where we had the foreign workers. However, I think Singapore government has really been really patient, and then wait for this curve to pretty much get broken before gradually reopening the economy. So that's about US as a whole. But if you look at certain states that open the economy early, like Florida, like Texas, in fact, they are not just edging past the previous peak. They're way, way, way past their previous peak, probably double. If you look at the white line and the blue line. Okay, So I said, in fact, that's really like what we said at the May 20th Grey Rhino Show. So with this continue, I think it could be quite likely. And it may actually force the hand of a U-turn of some of these states. To be able to, actually not to reopen the economy so quickly. And hence I said, the longer this drags on, the greater the chances of insolvency risk. Which the companies will not be able to survive because their savings are drained day by day, week by week, month by month. So that's really still a risk out there. However, let's talk about this thing. Different stocks, different routes. So don't think about the stocks are the same, especially in this COVID-19. We talk about a very polarized world where different stocks take a different route. So it's not a homogeneous world. So being able to pick the right companies, which is actually a main theme in this show, will be very, very important. Not just over this crisis, even way past this crisis. So I think it is. You can come for this show and invite your friends to get educated about this. I think it's going to help them a lot in the decade. What do I mean? Okay, this is 17th of June, which was the last Grey Rhino Show 2 weeks ago. I was showing the STI versus Microsoft. So STI, which is Straits Times Index, pretty much represents our Singapore 30 biggest company, which are largely cyclical stocks. At least I was looking, 80% of Singapore stocks probably fall into cyclical stocks. Cyclical stocks, for those who join us the first time, are those that will bounce up and down according to the economy. Okay, so you can look at it from the start of the year, they're down 16% as at 2 weeks ago. Microsoft is already up 25%, which I say in any given year, it would have been a good return. Let's look at what happened 2 weeks later, where there's a risk of this resurgence. 2 weeks later, this is what happened. Okay, so Microsoft has gone up to plus 28%. And this was at last Friday. I said yesterday at a record high, which reached $203. So it's probably closer to 30% now. STI from 16, it dropped to 19%. So from 2 weeks ago, Microsoft is up 4%. As at the weekend. Whereas STI is down 3%. A short 2 weeks, which caused a 7% divergence. So I think it's really important. When there's any trend or any hints of a downturn of a second round of this resurgence, the cyclical companies are going to be affected a lot. And hence, if you're going to bet on a V-shaped rebound to catch the cyclical companies, I think that presents a pretty big risk. But if you buy companies like Microsoft, it will have the temporary volatility like you see in March, but the rebound was actually quick and furious. Okay, so there's a difference between structural growth company and cyclical growth company. So the question, this was a question that was actually posed by one of our audience to the panelists. That was the last Grey Rhino Show. Because from the 20th, the two Grey Rhino Show from the 20th May to the 3rd of June. In fact, companies like SIA, DBS went up a lot, whereas companies like Microsoft hardly moved. So the panelist so the audience was saying, it's not always Microsoft. Sometimes it's better to be in SIA. Sometimes it's better to be DBS type of cyclical growth company. And I agree with him. I call it catching that blip, that temporary upward blip. So later I will show you the graph. And then one of my clients were also telling me, because I was asking him to sell off some of his funds, which are largely consisted of cyclical stocks and also high yield bonds. And at the time, he asked me, hey, now the economy is recovering, my fund is recovering, should I still sell? I shared with him, yes. Let me share with you why. Okay, so this was that period. So if you see the purple line, that's SIA. SIA from the 20th of May to 3rd of June went up about 22%. DBS went up about 18%. Microsoft went up 0%. It was flat over that period. Yeah. So in fact, what that friend said was true. If you can catch that blip, over that 2 weeks, yeah, you would have made pretty quick gains for DBS, SIA, or this kind of cyclical growth stocks. So what did I share with my clients who asked me whether you should sell? I said yes, but you got to be willing to forego that blip if the V-shaped recovery happens, which I think is not a high probability. I said if it happens, that blip will continue. You could have a possibly 30, 40, 50% gain in a short space of time. I shared with him, for me as an investor, I'm willing to forego that. If I can see the long-term attractiveness of structural growth companies, yeah, I'm willing to forego that 30, 50%. Yeah. Then there's another of my colleague's client asked me, but these stocks will eventually recover. Yeah, SIA will recover, DBS will recover, right? So it's a matter of time. It's true, it's a matter of time to recover. But what if this downward move, so now you're looking at this downward move for both DBS and SIA. What if this downward move is a move of 50%? So the economy gets so bad because of, let's say, the resurgence, and the economy moves down 50%. And eventually it recovers, and there's an upward blip of 30%. But if you buy today, you are still below water. Yeah? And for such companies, you could stay below water for a long, long time, and might be even forever. So that's called permanent loss of capital. Yeah, so I said, you got to be willing to forego that blip, which I'm willing to, because if I can have, like Microsoft, since the previous peak in October 07, if I can have 566% growth over 12 years, that's good enough for me. I don't have to cash at temporary 30, 40%. But if I missed it, I may suffer permanent loss of capital. Yeah. So just talking about since 12 years ago, DBS is down 4%, SIA is down 80%. Yeah. So that is if you miss that blip, or if you can't sell it in time, and that could be the long-term fortune. And that to me represents a risk. So I look at risk and reward. I tell my clients, if I were you, I would stay in the structural growth, but he has to decide for himself. Okay, so I say really different stocks, different routes. Okay, this is what we talked about the last time. The twin tool, the twin decisions in the investment decision are asset allocation and asset selection. In this show, we largely focus on equities in asset selection. So we talk about cyclical growth companies, which we use DBS as an example. We talk about mature and stable company, which we use ST Engineering as an example. And today we'll talk about structural losers, which is, in other words, landmine. So I think it's you wouldn't want to step on them. Okay. The structural decline represented by the SPH. Okay, so like Sherry mentioned, on the 6th of June, SPH was actually removed from the STI, replaced by Mapletree Industrial Trust. Do you know STI? What is the long form of STI? Straits Times Index. Straits Times Index was actually founded by SGX and SPH in 1966. It took a different name. It was called STII, Straits Times Industrial Index, and renamed to Straits Times Index in 1998. Okay, so it was quite sad, the SPH, the particular index that it founded, Straits Times, right? The Straits Times Index. Straits Times, the newspaper suggests. Yeah, it's founded by SPH. Today, it had to be removed from the index it founded. Similarly to the story of Steve Jobs. Yeah, Steve Jobs, where he founded Apple and he was booted out by the Apple board. But eventually he came back and turned around Apple. That's later what we talk about as well. Will SPH have a similar kind of turnaround, like what Steve Jobs did to Apple? Yeah, let's discover that later on. Okay, so what we're going to talk about is this. So the past, we'll talk about the 13 years profit trend, share price trend, dividends trend. And interestingly, it's the last question, were there sufficient telltale signs to get out before the share price collapsed for SPH? And then for the present and future, we look at any turnaround opportunity. I say like what Steve Jobs did to Apple. Is that going to happen for SPH? Because Apple would have earned a huge fortune. Yeah, for anybody who got in when it was about to go bankrupt. That was when Steve Jobs rejoined. Let's look at the past. Let me ask you this question first. Maybe we can also take a polling. Shall we, Srin?
Yeah, sure. Very interesting, because when I first saw this question, initially I was thinking, hey, the answer is very obvious, right? Plus, because I did my internship in SPH when I was in university. So anyway, I shall not review anything. Maybe for our friends who are with us today, just now I shared with you on how to use the chat, right? Can you share with us, what do you think are the core businesses of SPH? You can just type in the chat group, just type your short answers, and then remember when you key in, right, can you choose to all panelists and attendees? Any answer from any of you? Okay, I see ads, advertisement, media, publishing, media, newspaper. Okay, newspapers and magazines, real estates, newspaper, reads traditional media. Ah, very good. Anything else? Okay, so Hikwi, all sorts
Yes.
of answers. So I think our friends here today, they know SPH quite a bit. So mainly they mentioned about the media, newspaper, and then some mentioned about property as well. Yeah, publishing of newspapers in both print and digital editions.
Yeah.
So
Okay.
pass
Thanks
back
a lot,
to
Sherin. Thanks a lot, Sherin. And thanks a lot to also all those who participated by writing down your answers. Yeah. So everybody got it, all combined, we all got it right. SPH has got two main businesses. Yeah, of course, its most well known is media. Because 20 years ago, it was the media king. Yeah, he owns the sole newspaper in town, almost, yeah, Straits Times, 联合早报, 晚报, all published by the SPH. And he owns one of the two TV stations in Singapore. So it was very, very well known. In fact, when I first started investing in 2001, people was saying, if you want to invest in the bluest of the blue chip, invest in SPH. It's the best company in Singapore. At the time, when I first learned from Warren Buffett, right? Warren Buffett loves to buy newspaper. Yeah, and because he said it is the gatekeeper to eyeballs. If you want to publish, you want to advertise, sell something, you have to go through newspaper. And some of the participants also got the second one right, which is actually in property. Later we shall look at it, what proportion does each contribute to SPH. Okay, let's look at SPH earnings over time. Okay, you can see it's downtrend. So over the 13 years, actually SPH earnings is down 52%, half. Okay. How about its share price? Okay, so its share price, as I say, the late Benjamin Graham, the teacher of Warren Buffett, he said, in the short term, the stock market is like a voting machine. In the long term, the stock market is like a weighing machine. And you can't escape it, right? If a person has how much weight, when stand on the weighing machine, it will show the exact amount. Yeah. So as stocks, there's no mystery around the direction of stock price. It's not exactly, but it rhymes. So as the stock price dropped 52%, as the earnings dropped 52%, its share price also dropped by 72% over the last 13 years. Okay, its dividends dropped about the same amount as earnings, dropped 50% over the last 13 years. Okay, so that is just I don't delve too much into that, but basically it's declining. The interesting question is, were there sufficient telltale signs for us to get out of SPH in time? I also have, like what I shared internally with my colleague, were there enough time to get out of high flux before it collapsed? Let's look at this. If you look at this SPH share price, as recent as mid of 2016 or early 2016, SPH share price actually held above $4. So it actually held up. And the big decline, it dropped from $4 plus to $1.30, was actually from early to mid 2016. And hence, if there were any telltale signs before 2016, it will actually allow the investor to get out of SPH without significant decline in their capital. Let's look at, just at a glance, because these are very evident things. Let's look at earnings per share. So if you look at the earnings per share of SPH, actually started declining in 2012. Right? From 2012 to 2016, it's got 4 years. So investor could have 4 years of telltale sign for them to move out of SPH before suffering a big decline in the share price. Let's go a bit deeper. How about if we look at profit from operations? What's the difference between the first one and the second one? Okay, the first one is profit. It could include some one-off gains. Like if you remember, SPH used to own the Times building at the Great Wall City there. So he sold it for a one-time gain. He used to own shares, pretty significant shares in StarHub. He sold it. And then also booked some gains. Okay, so all those gains could temporarily buff up the profits. But when we look at profit from operations, this chart, we are looking solely from its operations. And we actually get even a 2 years head start. Because as early as 2010, the profit from operations has actually started to decline. So we get actually a full 6 years of telltale signs before the share price started declining big time. Thirdly, we look at its core business. I think just now from most of the participants, most of our audience here, they name, when talk about SPH, they immediately think of media. And they are correct. So media is their core business. So the core business has declined in 2011. Okay, so regardless of which indicator you look at, we can have 4 to 6 years of telltale signs before the share price decline seriously. So again, it's not a complete absence of telltale signs. So later on, we also look at what could be some of these telltale signs. And if you want to look at your own portfolio, are there some of these signs? Then I think, and if the share price is still held up quite well, you may want to consider to go a bit deeper and to consider whether you should liquidate at current price and take whatever gains or loss protection that you can have. So now the next interesting story. Any turnaround opportunity for SPH, just like Apple had for their shareholders. Okay, I broke down the last 10 years, the SPH media and property profits. So you look at media, it's probably a one-way traffic. From about 350% down to about 50%. Okay, this is all in percentage-wise. Whereas the profit from property actually has been progressively climbing upwards. So let's look at the media first. So let's look at the latest earnings update. So that was in first half 2020, which ended in end of February 2020. So that it was actually down year on year, by 15%. So they continue to face a decline in their operating profits. Let's look at the media. So I broke into two again. So from first half 2019 to 2020, media is down 76%, property is up 17%. Okay, so for media-wise, SPH is trying to transform from a traditional media to going digital. Okay, so let's look at it. So let's look at just revenue. On revenue growth, because advertising is a big portion of earnings for media companies. Yeah, so its digital media advertising revenue has gone up 500,000, whereas its print media advertising has gone down 32 million. Yeah, so I say that its new venture into digital media is way insufficient, yeah, to offset the decline in their traditional print media advertising. So you look at it, SPH is both at this moment, yeah, is at a structural growth, structural decline is something that is permanent, I feel, because the digital digital media business is unable to catch up, or unable to compensate for the decline in the print media. And at the moment, because advertising is a very cyclical business, in downtime, companies cut back. And one of the most immediate things is they reduce their marketing through advertising. So advertising is a cyclical business. So now because of this current crisis, it's facing both a structural and cyclical downturn. So not very bright, especially in the short term. So my thought is turnaround looks difficult. Because today the competitors are not local. Yeah, they are facing, I'll say, global competitors like Facebook, Google, yeah, for advertising dollars. So I think it's pretty formidable, the kind of competitors they have. So I think it's going to be pretty tough to turn around. How about their property? Okay. So for just now, we are asking what business does SPH in? So those who guess property, you actually got the majority right. Because 90% of the operating profit today actually comes from the property segment. So if you look at it, I'll say SPH is almost going to be a pure property company. Yeah. And then in the last 1 year, they actually added 1 billion of investment properties, which is why you see the property operating profit actually gone up. Yeah. Not so much because the underlying property has done very well, but because they have invested more. Yeah, they invested an additional 20%. They expanded their investment properties portfolio by 20%. And lastly, is in purpose-built student accommodation in Europe, largely UK. And it's fully financed by debts. So if you take on cheap debts to buy assets, there's always a chance to temporarily boost up profits, because today debts are cheap. Let's look at its property portfolio. Okay, so it owns SPH REITs. So if you look at this, two property stands out. So SPH property portfolio is today at about 6 billion. So if you look at Paragon is about 3 billion out of the 6. So it accounts close to half of SPH property portfolio. And then another about a quarter is actually what they recently bought, UK student accommodation. Let's look at the biggest one, the Paragon, Orchard Paragon. Okay, so this is actually from C.B. Richard release, which is talking about the prime retail rents. Prime retail rents refers to the prime areas, like especially Orchard Road. So the prime retail rents has been coming down for the last, how many years? 2014 from this chart to today. And that's about 6 years. So it's been coming down for the last 6 years. Okay. And then it's forecasted to continue declining, according to C.B. Richard list. Yeah. So I say, if you look at prime retail properties, I would say it is in a gradual structural decline. Not a very bright spot because of this. So you look at Zara. So Zara recently said, the Inditex, which is the owner of Zara, said it is permanently closing as many as 1,200 stores, which is 16% of its worldwide outlets, because it is going online. And then this is what my wife told me, because my mom-in-law likes to shop at Esprit, and then it's closing 56 of their stores in Asia outside of China, including Singapore. So all these retail outlets is closing down, and this trend is accelerated by this recent COVID-19, because people who are not accustomed to shopping online are kind of forced to shop online. And after these 2-3 months, it may seem short, but a new habit has been formed, which is shopping online. Just like how I'm using Zoom, a new habit has been formed. And because of this, I think it's going to accelerate the downturn of prime retail. Because prime retail are especially selling all these discretionary items, which I say buying clothes, all these things, which I think a lot of it can be done online. So my thoughts on SPH property segments, I think it's also facing a risk of structural decline, unfortunately. And if I compare it to CapitaLand, why CapitaLand? Because CapitaLand, I think, is about one of the most innovative, experienced, and diversified property company in Singapore. So if a person wants to invest in property companies, I think CapitaLand is probably the king. Not that I like properties, okay? Because properties today, I think, is no longer king. Unlike our grandfather's time, or father's time. Today, the intangibles are the king, not the tangible. Okay? So, but if I look at valuation-wise, price to book, that means the price relative to the assets that they hold, they are both at about 60%. It means SPH is not any cheaper as a property company relative to CapitaLand. So I say, if I have to buy a property company, I'll probably go for CapitaLand. More diversified, more experienced, more innovative, and more focused. Okay, so I think my conclusion for SPH is the media business is in structural decline, low probability of turnaround, almost a pure business, pure property company now. And the properties, unfortunately, are not in the structural growth areas. They are in the structural decline, largely, or mature and stable, which I think the student accommodation could be in the latter. But they're not unique. There's not student accommodation are not unique assets. Which I say it runs a risk. People can come in and build more. So my take is I will continue staying away from SPH. This is not a recommendation. This is just what I would do, if I were to look at SPH today.
Thanks, Kitwi. Before you move on, because we have a friend today, Roger. Roger is asking a question pertaining to SPH. So I thought it would be good for us to address to him before we move on.
Sure.
Okay. So Roger mentioned SPH seems to be working with Keppel on data center. So what's your take on that?
That's a good question, Roger. Generally, I like data centers. It's probably one of the few property type that I like, because it's probably considered a structural growth where the world will demand more and more of that. However, it has to move the needle, right? Because it has to have critical mass to move the needle. I've read about that. I've not dived into it. However, I think as an investor, if you want to see will that be the reason of the turnaround, well, I have to see at least this part of their property ranging from, let's say, 30% and beyond of their total property portfolio for it to pull the entire business up. Of course, I think that is it's a good property sector in my view, because it's in a growing sector. Firstly, you got to look at the size of that deal, whether is it enough to move that needle. But however, I think short-term wise, actually data center is a bit of an oversupply. But long-term wise, I think it's going to be quite good. So I think look at two things. Firstly, how significant is that? My own guess is slightly not to be very significant, compared to the overall. Because if I see the last 1 year, their main investment is not in data centers. It was on those student accommodation. And today, their debt has actually climbed up to the same level as CapitaLand, about close to 40%. Which means the headroom, to take on debts to actually increase its property portfolio will be more limited. That's why I think it may not be able to go into that in a big way. And how experienced are they in this area is also a question mark. Because in stocks, the good thing is we don't have to stay within one company. If you are not sure, I won't even say if I don't like the company. I'm not sure. I can always move on. that is the beauty about investing as a public shareholder. Roger, I hope I answered your question. Unfortunately, I have not dived deep into that. I've read about that, but haven't dived deep. Hope it was a satisfactory answer. If not, continue to let us know. I will look into that and answer you in the next session.
Okay, thanks, Kate. Thanks, Roger. Roger, if I'm not wrong, I think last session you also asked a very meaningful question. I think this is the kind of interaction that we really enjoy. Okay. Kate, you
Okay, I move
pass
on.
back to you.
I got a bit more. Yeah. Okay, so other companies showing signs of structural decline. Okay, I just show another two pretty well-known one. You may have already know. Okay, one is SingPost, but intuitively, we can say it falls in the same category as SPH, where the internet has disrupted a former monopoly. Where SPH was a monopoly, Singapore Post was a monopoly. Yeah, so the internet has disrupted the monopoly. Yeah, and hence, since 2016, its earnings has been declining. Second one is actually StarHub. Yeah, in fact, not just StarHub. I think the telcos, my fear of them is, will they move away from mature and stable into structural decline? Because by and large, telcos don't have a lot of, they're not very unique, in terms of the business. Yeah, and then with the introduction of the fourth telcos, there's been a lot of price cutting. So the StarHub's earnings has been dropping. And not to forget, StarHub has one business, which the previous STV, is pay TV business, which is almost certain to go the way of the dinosaur. Because with Netflix, I don't think people will want to subscribe to pay TV. There will be less and less over time. So that's one business I think that was sure to decline. So StarHub has declined quite a fair bit. And even the latest results announcement, it said it's actually cutting its, abolishing its guidance of its dividends, its earnings outlook because of COVID. But actually, I think COVID by right shouldn't have much of an impact on telcos, because telcos are supposed to be pretty defensive companies. So I'm not sure, is it a mask for something that is worse, or is that really the case of COVID affecting so much of their business? But in any case, I said, if we are not sure, we always have the advantage of staying out and looking at other companies which we are more certain of their future. Okay, so are there some of the telltale signs of structural decline company? Okay, these are not the deep diving type of telltale signs, because I know not all our audience here will want to have the spend the time to go deep diving into SPH, spend days to look at it or the company that they own. So I'm looking at things that are quite easy to identify. So it's not a catch-all. Firstly, the most apparently look at the operating profits during usual economy. Even during a usual economy, the operating profit is showing signs of decline. Then I think just for the benefit of the doubt, I think it's better to just get out of it first. Because by right, in a usual economy, for a strong company, it shouldn't be having falling operating profits, especially if it's large. Secondly, if its core business is suffering, like I say, if media is the core business of SPH, mobile is the core business of StarHub. So the core business must be resilient. It's no point that the profit is propped up by acquisitions, by its other businesses, because you're not buying the business for that. So one way to look at the core business, because if you sometimes look at just the overall earnings, it could be masked by the other acquisition, which in the past this company called China Aviation Oil, long ago, where it's a declining core business, is actually masked by the other businesses they acquire. So look at the core business, which you can look at things like operating profits or underlying profits. Look at how its core business is doing. And the third one is more intuitive. If you happen to be the consumer of that company's product or services, and if you yourself has reduced using that product, or you pay less and you can get more, then I think you don't want to be on the other side. It's always, it's not a win-win. I mean, generally, I say use like in the case of airlines. Airlines have been cutting fares for the last 20 years. Yeah, so as a consumer, I pay less and less to travel. And if I get the benefit as a consumer, I don't want to be that. I don't want to be on the other side, which is a company having that service. Yeah. Similarly for StarHub, I'm a hubber. Every time I go back to StarHub, they keep telling me ways to reduce my bills, and it's a significant reduction. And I know if that happens to me as a consumer, I don't want to be in their shoes. However, I think the next question is probably quite particular because what do you do if you have structural decline companies and the shares have already declined substantially? Okay, so I think this is I can empathize that because sometimes this company has you may have some emotions attached to it. You've had it for a long time. They used to be the blue chips. They are very well known. And you've already been sitting on some paper loss. So a lot of time people hope it will recover. My own experience, because I do portfolio repair, which means I look at other people's portfolio and I advise them. Every time, when I look at it, most people are very reluctant to sell to companies which are sitting on losses. But almost without fail, when I look back, if the person is not willing to sell, usually he will make even more losses. Where if they can switch it, so not sell it, switch it to a higher quality, a better growing company, in fact, over time, they can make up their losses. So the make up for losses, my view is really to take the pain. We make that mistake from time to time. Some people more, some people less. I think it's time we have to sometimes cut that loss and really reinvest that capital into better companies. Because an opportunity cost for you to hold on to a company that's in the state of decline. So if you're not very sure and you want some advice, you could really look for the person who invited you, the consultant who invited you here, to see whether, do you want to do a review of your portfolio? If I'm not sure. Which one should you hold? Which one should you let go? Which one should you buy more? So I think those are things which we can share our views with you. Okay, so next week, we're actually talking about structural growth, and which I think is going to be the most exciting segments. You just look at their share price, right? Or the 4 types of share price. Structural growth companies like the Microsoft type, really have a big upturn. Okay, so I think we will look into one of these companies, maybe several of these companies over a few weeks. And we want to be able to equip ourselves to be able to identify such companies. Okay, so this is the end of my sharing. So I think I'll pass the time back to Shereen. Thank you very much.
Thank you very much, Kit Wee. Thank you. Now we'll move on to the Q&A segment. So the question that we have consolidated today is actually from the previous session. So same thing, for example, if you do have any question from the session today, you can type it out in the chat. We will consolidate it. It could be one of the questions that will be addressed in the next session. Okay, so Kit Wee, shall I share with you the most chosen question for today?
Yeah, thanks. I saw that question.
Okay,
let me go.
Sorry?
Yeah, so go on. Please go on.
Okay. Recently, pandemic cases have risen in US and other parts of the world. With banks are not allowed to buy back shares, will this drop in stock price be a temporary or permanent one? Okay,
thanks. Just to give some backdrop to this question so that everybody will know. So the US government said they're capping the banks' dividends. That means they cannot be raising their dividends and they cannot be buying back shares. What they want to conserve their capital. Buyback, I think it's until the end of this year. So that was just a few days ago. We had this news. So my question, my answer is, okay, we got the first, like the banks. Okay, so this, I'll say, capping dividends or reduce, not allowing share buyback. it's not going to have fundamental impact on the business. Of course, it does impact sometimes because buying back shares could have a way of increasing their earnings per share without actually increasing the actual earnings. So I say it does not alter the long-term fortune of banks. So I think we got the first, I would say, take away this news and we look at bank as it is first. Would you like to own banks for the long term? I checked at the session with the cyclical growth. Let me just look at and then let me just review, revisit some of these banks. How have they done over time? Let's look at US banks. Okay, if there's anyone you want me to show, you can actually type in the chat group. If not, let me find a few first. Okay, let's look at Goldman. Okay, Goldman Sachs, a very well-known bank. And go. Goldman Sachs. Okay, let me show. Yes. Goldman Sachs. Okay, let's look at Goldman Sachs. So this Goldman Sachs share price. Okay, so if you look at, for instance, the last peak in 07, it has probably at max close to it. So it's nowhere gone past that peak. And that's quite a good news for banks. So that's okay. So I say so banks have not really done very well over the last 10 years. Let's look at some others. These are the better run US banks. Morgan Stanley. Let's look at Morgan Stanley. MS. Okay. Let's look at Yahoo. Sure. Okay. So this was actually, so this is the share price of Morgan Stanley. So you look at it, it peaked in 07 at about $84. And today it's $48. So I say quite a long distance below the peak in 07. I will look at the worst one now, Citigroup, banks like Citigroup. So if I ask me, there are two things that's facing banks. Okay. Let me get out of my screen. Okay. Yep. So I think two headwinds for facing the banks. The first headwind could be a shorter one. That means it's because of this COVID-19, which is a credit risk. All banks face credit risk. So if this credit risk means the bank lend out money and they cannot collect back. Okay, so if this downturn lasts longer than most expected, then the bank's credit risk will be larger. And most banks are highly leveraged. If they lose every $10, if they lose $1, most banks will become insolvent. Okay, so I think if this COVID-19 crisis gets worse and insolvency starts to happen, bank will face a very big but probably near-term headwind called credit risk. And being short-term, usually I'm not that worried. But the long-term headwind is really the very low interest rates. And already, Jerome Powell said, 0% will stay minimally until end of 2022. I think it's going to last a long, long time because with this massive amount of government debts, the government will find it difficult to be able to raise interest rates. Like what Jerome Powell was trying to do in 2018 was trying to normalize interest rates. And when the stock market threw a tantrum, he listened to the stock market and then decided to maintain interest rate, and shortly after that, do a 180% turnaround to reduce interest rates. So it faces both a short-term and long-term headwind. I'll give an analogy. I'm sure for gentlemen and ladies here, we have all run our IPPT, like 2.4 kilometers. Even when I was doing army, so sometimes we will say, hey, choose the route that is downward sloping one. Yeah, this is all the way you run. Your end point is lower than your starting point. Because it saves energy, run downhill. Even the best marathon runner, I'm sure they run faster running downhill than running uphill. Yeah. So that's talking about the environment. Yeah. So the environment, if it's running uphill all the while, then it's going to be very slow. But rather, if I'm going downhill, even a lousy runner like me could run quite fast. Yeah. So I'm thinking, so long term, I don't favor the banks because they're facing the headwinds. So if you're talking about this, in fact, the share price dropped, but not very significantly. When the dividends were capped and the share buyback was banned for this year. And subsequently, it's actually rebounded a bit. So I said, unless you really want to be catching that blip, like I was sharing just now about friends who want to invest in SIA and DBS to capture that blip. And if you are very sharp and precise, and have a good confidence where the economy is going, then maybe you may want to catch that blip because it can come quite fast. Turn up 10%, 20% in a short space of time. But the risk is if you can't catch it and we drop further, there's a risk of permanent loss of capital. So that's my response to the first question. Hopefully it's acceptable.
Thank you, KV. Thanks. We'll move on to the second question. In fact, over the past few episodes, we will get questions about different types of instruments. Are they good to be invested in? So this particular instrument, actually we get it, I think, quite a few times already, asking about ETFs. So the question today will be, is ETF a good investment tool to go into?
Okay. So thanks. So the question pointed out correctly is a tool. It's not an asset class. Okay. I just differentiate for you all. So things like stocks, bonds, commodities, real estates, all these are asset classes. You're talking about, let's say, if I want to buy a certain stocks, either buying it directly, buying it via unit trust, or buying it via ETF. That's a format of investments. You can call it a tool. Okay, so I think ETF is a tool. I think it's helpful for investors who don't want to do deep research. I think investors who don't want to do deep research, that's my view. You don't have to agree. I think shouldn't try to avoid buying direct stocks. These individual stocks, you pick it and buy it. Because I think the risk will be quite high. Because you're not monitoring it closely, spending a lot of time. I say the decay could happen before you know it. So buying ETF has much lesser of the risk because it's diversified. And it usually follows some indices, right? For example, let's say you talk about the Straits Times Index. When SPH does not do well, gets too small, it just gets switched into Mapletree Industrial Trust. So that renewal process happens automatically on your ETF if it's tracking certain index. And hence you get the renewal process within your index, within your ETF, plus it's diversified. So it really reduces your single stock risk. So I think that's good for people who want to stay passive, who don't wish to use the help of an advisor, they just want to DIY. I think that's good. However, I think it's still what to invest in that's most important. Because there could be many types of ETF. ETF that mimics or replicates the Straits Times Index. You could have one that replicates the S&P 500, one that replicates technology companies, one that replicates biotech companies. So which ETF should we go for? In fact, that is the more important question. It's not about should I invest in stocks, should I invest in ETF? I think we have to. Because there's no much alternative out there. Why you want to put your money in cash, which you know almost for sure you're not going to earn anything on your cash for a long time, maybe forever. Bonds are getting very uninvestable. So I think we have to. We don't have a choice. So it's what? What kind of ETF? Again, I think the same principle applies. But unlike stocks, you can't pick directly the stocks that you love, because you can't tell the ETF manager what stocks to buy. He chooses the stock, not you. So you buy the ETF. And hence you can only go for the best fits. You cannot go for the exact fits to what you want. But for a passive investor, that's fine because you may not want to be spending your time finding the exact fit also. Yeah. And hence I will even buy ETF. I suggest go for the same thing. We have the 4 types of company: mature and stable, cyclical growth, structural decline, and structural growth. Go into those areas which are more fertile ground for structural growth. Not the entire sector. Within a sector, there can be growth and decline companies. But let's say you talk about technology, you talk about biotech. Yeah, those grounds are actually more fertile for structural growth companies. And hence, if you pick ETF in those areas, you're likely to have more of such structural growth company. And maybe have some of those more generate indices. So some of these generate indices and add on some of those more structural growth sectors. I think that could work for ETF. Or if you really want to buy a direct stocks, have a portfolio that is unique, that is not replicating an index. Then I think looking for the help of an advisor, if you do not wish to DIY, is really a pretty good way to go. Because someone will be choosing the exact fit for you, and then monitoring for you. And that reduces your risk a lot. So that's my take on ETF. So it's not so much whether ETF or not. It's, I think, what type of ETF.
Thanks, Kigli. Thanks for sharing with us the answer to your views on the second question. Actually, the last question is asking about asset class now, about gold. So what is the outlook of gold in this current market situation?
Okay, thanks, Shereen. Okay, gold. As I said, the primary determinant of gold price is real interest rates. The real interest rate is interest rates less away inflation. Okay, so we got to know where these two are heading. Of course, gold has another element which is a safe haven asset. But the primary is really the real interest rate. So let's look at it. Interest rate, I think, is quite well known. In the short term, it's going to stay very, very low, close to 0%. In the long term, my guess is it will stay close to 0% because of this massive amount of debts. So then, interest rate side, we maybe have quite a good guess. Inflation side, okay. So we have inflation side. Is it going to go up, come down? Okay, I think in terms of consumer price inflation, we may not face a big inflation anytime soon. Because people may be more of decide to save more coming out of this pandemic, and economic growth is slow. But there's the other inflation, which is asset price inflation. And that's where all the money has been channeled to cause inflation, which is why the rich-poor divide is very wide. Today, the rich gets richer, the poor gets poorer. Because the rich fight on asset inflation. Whereas most of the people who are not less acquainted with assets, stayed away and they didn't benefit from it. So I think, so in the looking at these two, I think there's a greater chance that gold will move up rather than down. Because at least one is fixed. The interest rate is not going to go much. It's going to hover around this range. So even at this time, I'll say, in fact, last time we think gold could be a good place to be in crisis time. And then, at the bottom of the crisis, we should sell out of gold, we should buy stocks. My view is not quite the same. I think gold, at this time where money is printed at will, in my view, should be a permanent holding. At least part of the portfolio to be gold. 5%, at least, I think. Because the portfolio that I manage, we put about 10 to 20% in gold. So we have overweight position in gold because we think with this massive printing of money, low depressed interest rates, gold should be doing well. So what I recommend is people should have a permanent holding in gold, say at least about 5%. And if you like it more, if you overweight it, say like what we are doing, 20%. But it's just a guide, I think. But I feel in this time when money is printed at will, the fiat money is, there's no fundamental worth. because we printed a wheel. So I think it's good to have gold in your portfolio as an insurance, if not for anything else.
Thank you very much, Kiwi. Thanks. I saw a few questions in the chat as well. So like what I mentioned, all this question that is being indicated, we will take that into consideration. So do follow us for the next episode. Okay. Now we have come to an end. Sorry?
You want to answer this question in a very quick session, then we will elaborate more in the next session. Do you think that's good? Or you prefer we don't have time?
We may not have time today.
Okay. Okay, I shall abide by my host.
Next session, we will be more efficient again. Thanks, Katie. Thank you. So we have come to the end of our Q&A session. Then before we end the show, because we know that all of you set aside the time to join us, right? And we hope that this session has been very fruitful to you, and we want to end it with just a game, so that we have absorbed all the knowledge, we have shared with you our views, and then we just end it in a very fun manner. Okay, so now I will need you to take out your second advice. Advice. That could be, let's say, your handphone. Go to kahoot.it. So can we have the screen with the code, please? We'll move on to our Kahoot game for today. So once you are ready, go to Kahoot, KAHOOT.it. Can we also have the screen for Kahoot to be up? Yeah, so when you go to Kahoot, and then you can just key in 286. We'll wait for a moment for our friends to come in. Joining this for the first time, and let me briefly share with you, there are a total of 5 questions. So you do not just need to get the question right, you also need to be the fastest thinker, because you will take into consideration how fast you key in the how fast you key in the answer, and when you get it correct, that is when you can move up the ranking. It's very fast. Okay, we can do it for a while more. So for those of you who are already in, you can warm up your fingers if you want. Leave it up to you whatever that you want to do. Currently we have 42 players. I think we should have more friends come in. Let's wait one more. Okay, can we just take another 20 seconds? So for those who want to join us, please key in 286-347. Okay, I think that should be all. Okay, can we start the game? Are you ready? Okay, let's start the game, please. So first question. What is the infection rate? To key in your answers. Yes, so the answer is it has actually exceeded the previous peak. So 41 of you got it correct. Congratulations. Now let's see who is the one who is leading the way now. Okay, Sam. Sam, congratulations. Now you are leading the way. You are number one on the list. So with 960 points, followed by Newbie. Newbie, are you first time with us today? If yes, congratulations. You have done very well. 923 points. And then followed very closely by Ikan Bilis, my favorite food in my nasi lemak. Okay. Next question, please. What kind of company is SPH? This should be very simple. Kate will be very upset if anyone gets it wrong. So is SPH a cyclical growth company, mature and stable, structural or a structural winner? It's very simple. But all of you keep the answer. Three of you have gotten it wrong. No worries. No worries. Probably you missed our episode on cyclical growth. But you can find us on YouTube. Okay, we did DBS for 2 episodes. You can go back and then listen to and watch our episode again to understand what is cyclical growth company. And at the same time, congratulations to the 45 friends who have gotten it right. Let's see the ranking now. Is it still Sam? Okay. Oh my God, I don't know how to pronounce this. Is it milk gile? I'm very sorry. I do not know how to pronounce it, but congratulations, you are top now. And oh, you are together with Moon. So we have 2 champions leading the way now, followed by Ikan Bilis, WT, and Sam. Next question, please. When did the share price of SPH start declining permanently below $4 per share? So it's actually quite recent. Just 4 years ago, it started to decline permanently below $4 per share. Congratulations to our 28 friends now. Let's look at the ranking now. Moon, you have overtaken our friend by 1 point. Okay, Sam, you are catching up. Now you are in the 3rd place. And then Porter and WT. Wait for you to catch up with our friends in front of you. Okay, now we will move on to the second last question for tonight. When did the operating profit of SPH start showing decline? Same thing, which year is it? 2007, 2010, 2015, 2016. Is it related to the I don't know. 加油 to all the leaders. So it looks like this question, not many of you got it right, and the people who chose various answers is actually quite close. So remember, it's in 2010 that the operating profit of SPH start to show significant decline. Okay, let's look at the ranking now. Can I call you MG? Because I feel very bad if I keep saying that I cannot pronounce your name, but I really can, so I'll call you MG. MG, congratulations, you have come back to number 1, followed by Sam, and then Gantengnya, KS, and C Ganteng. So actually, what is Ganteng? Is it an auspicious name? Okay, now we are coming to the final question. So let's see. Which property within SPH's portfolio has the highest valuation currently? Is it Paragon in Phuket, 17 Mall, Seletar Mall, or Unicorn? Hi, Ganteng is handsome in Bahasa, so we have two handsome friends with us today. Okay, so it's Paragon. Very good. Majority of you have gotten it right. Okay, now let's come to the last time we will be looking at this ranking. Who will be the one who will walk away with our surprises? Okay, Jim, you have gotten 5 out of 5. Alvin also gotten 5 out of 5. And number 1, our champion today is Kim. The previous winners, okay, the previous friends who were leading without any signaling. But well done, we like it that way. So KS, if you are able to just drop the panelists a private message, okay, for your name, we will really appreciate it, because that is, after the show, we will arrange to send you your surprise gift. Okay, thank you very much. So we are out of this. Okay, thanks for being with us today, and thanks for having fun with us. We really hope that this is a very fruitful and interactive session for all of you. So before we end, I'm just going to share with you the registration for our next show. So for those of you, if you are already in our subscription list, you do not need to register. Again, you do not need to scan the QR code. Just like what has happened for this episode, our colleagues will be sending you the details for the next episode. So the next episode, episode 6, is going to happen on the 15th of July, same day, Wednesday at 8 p.m. We are still going to have a case study, like what KP mentioned, right, on structural winner. But which company is that? We shall keep you in suspense. Okay, so for those of you, if you would like to join us for the next session, you can scan the QR code. Later, as you leave the show, there is also going to be a link to link you to a feedback page. We will be grateful if you can leave us with some feedback so that we can continue to improve from here. And then at the same time, if you do wish to subscribe to our list so that you do not need to register it every time, right? You can also do so in the feedback link. Okay, thank you very much. That's all for today. For those who want to catch up on the political debate in Mandarin, you can turn on your TV, go to channel 8 now. Stay tuned. We will see you in 2 weeks' time. Thank you very much. Good night.